Have you ever thought about starting to invest, but got stuck when it came to putting together your first stock portfolio? Have you ever researched, heard terms like dividends, volatility, defensive sector, and ended up closing the tab because you didn't know where to start? Don't worry, you're not alone. Most people who want to invest end up putting it off for a simple reason. There's no clear, practical, and direct way to safely take the first step. In this video, I'll show you how to put together your first stock portfolio from scratch without needing to be an expert and without falling into the most common traps. And best of all, in an accessible, step-by-step way with practical examples that you can apply today. Before anything else, it's important to understand why putting together a portfolio is essential. Investing in a single stock is like putting together a soccer team with just one player. It might work for a while, but the risk of losing everything is much higher. When you put together a portfolio, you're distributing your money across different types of companies and sectors, which helps reduce the impact of market fluctuations. This is called diversification, and even if you are starting with little money, it is possible to apply this concept from the beginning. The idea here is not to bet everything on a trendy stock, but rather to build a solid foundation that protects you and helps you grow consistently. Now, to make this process easier, we will divide stocks into three categories that work very well for those who are starting out. The first are stability stocks. These are large, well-established companies with a strong presence in the market and a history of good results. They usually operate in essential sectors such as energy, banking, food, and sanitation. They are less volatile and help to provide more security to your portfolio. The second are growth stocks. Companies that are still expanding and have the potential for greater appreciation over time, such as some in the technology, health, and digital retail sectors. They carry more risk, but also more potential for return. And finally, we have dividend stocks. These are companies that share part of their profits with shareholders, usually paying a periodic income. This creates an extra income of money, even without selling the shares. These three categories together create balance and help you build a diversified portfolio from the start. But how do you choose good stocks even without experience or training in finance? The good news is that you don't need to be a professional analyst to get off to a good start. The first step is to focus on sectors that you already know or consume. If you understand how energy, banking, or retail companies work, start there. Then, check the company's history. How long has it been listed on the stock exchange? How has it performed in recent years? Does it make consistent profits? This information is available on websites such as B3, Google, or even on free apps such as TradeMap, Status Invest, or Simply Wall Saint. Another important point, keep an eye on recent news. Companies that are constantly involved in scandals or financial problems can represent unnecessary risks. Investing well at the beginning is more about choosing what is simple, stable, and understandable than trying to guess which stock will explode. Now that you understand how to select stocks, let's talk about how to divide your money intelligently when putting together your first portfolio. Let's imagine that you're starting with $1,000 or something around $200. A good starting strategy would be to allocate 50% to stable stocks, 30% to growth stocks, and 20% to dividend stocks. This creates a solid foundation, gives you exposure to growth, and still allows you to generate passive income. And if you're starting with less than that, that's okay. The important thing is to understand the allocation logic and invest proportionally to the amount you have available. Remember, starting small is not a weakness. It's a way to learn with little risk, gain confidence, and evolve consistently. After choosing the stocks and deciding how much you're going to invest in each one, it's time to act. And then comes the question, where can I buy these stocks? Nowadays, opening an account with a brokerage firm is a quick, free, and 100% online process. Choose a reliable brokerage firm with an intuitive app and good customer support. After opening an account, transfer the amount you want to invest. Look for the stock code, the famous ticker. Enter the amount and confirm the purchase. It may seem complicated now, but when you make your first transaction, you will see that it is simpler than it seems. And remember, you don't need to invest everything at once. You can divide it into 2 or 3 periods and get a feel for the market. Setting up your portfolio is just the beginning. From now on, you will need to take care of it, but do it lightly. Don't keep checking to see if the stock has gone up or down all the time. The ideal is to calmly review your portfolio once a month.